Welcome back to the channel, everybody. Today I've got George Pino. He's the CEO of Commercial Brokers International here in Los Angeles. He's also my business partner. And him and I were sitting around talking the other day about everything that's been happening in Los Angeles with properties getting damaged from natural disaster accident and tax implications and insurance implications. We really got into it. So I put some questions out on Twitter, and I got some questions that I'm going to be asking George today on those questions that I received. So George, first of all, thank you for coming in today.
Thanks for having me again.
He's got kind of detail. I will not lie.
Oh, all right, fun.
So,
Hopefully the viewers don't fall asleep talking about taxes in detail.
I don't think so, because this is some great information, and I actually learned a lot from this. And these guys had some really great questions. So I'm just going to dive right into it if you're okay with that.
I'm okay.
All right. What are the primary tax implications if a commercial property is destroyed by a natural disaster or an accident?
I see they're also asking questions that are kind of...
You got to be careful here.
It's one or the other kind of thing.
Do your disclosure.
So that's exactly where I'm going first. First I got some obligatory disclosures that I keep being told from attorneys that we need to make. First being, we are not tax professionals. We are not tax advisors. We are not giving any type of tax advice. Since taxes are very personal to each individual and asset type and situation, please consult a professional tax advisor that can give you the appropriate information for your specific property questions and needs. Now, in answer to their question, what's the main issue is? The main issue is you may actually owe taxes even if you lose the property. Mm-hmm. So let's talk about that a little bit more.
Yeah, I think it's going to be, I think a lot of people aren't aware of a lot of this.
Yeah.
So how does the IRS treat a property loss? Can it be written off as a casualty loss?
Well, again, did they write the DRE question test too? Because it sure sounds a lot
Some
like
of these,
it. It's like yes and no.
Well, one of these was from an attorney, I know that.
Okay, so yes and no. Yes, you can treat a property loss as casualty loss depending on the type of property. So typically speaking, or actually how the property was lost. Meaning, typically speaking, residential properties, things like that, are not really subject to that casualty loss or deductibility unless it happened in a federally declared natural disaster. Hurricane, fire, tornadoes. Has to be federally declared though, not state. In that situation then, they can actually write that property or deduct that loss off of their taxes.
And that's on residential. What about commercial?
That's residential. Now commercial doesn't have to be in a natural disaster zone or not. If it's actually destroyed, and by commercial, I'm talking about either properties used for business purposes or for income purposes. So even if it's a residential property, but it's for income, you're renting it out, and the primary use is income, this would then qualify. And in which case, it doesn't have to be in a federally declared disaster area. It automatically, you can deduct those losses from property losses or damage or casualty.
Okay. All right. If insurance pays out after a property is destroyed, how is that payment taxed?
Okay. Well, it may or may not be taxed again. So what I mean by that is it really depends on the property itself and the basis it is and how much and the type of asset itself as well. Meaning, if you're using the funds from the insurance and 100% of the funds from the insurance go to replace the property, then there's no taxable event. If you don't use the funds from the insurance to replace the property or repair the property, it now becomes income. So it can be taxed as income, not as capital gains. Okay. That could be much higher than capital gains. Mm-hmm. So you have to be wary of that, how you're actually using those funds and sources. In addition to that, your land has a basis. So even if you have payment coming in that may match the value of the land, if your basis on the land is lower than what the funds coming in from the insurance to take over the property or just release you from the property, then guess what? You're probably going to owe capital gains tax.
That's a slippery slope I wouldn't want to get into.
No.
All right. What is a qualified replacement property, and how does Section 1033, involuntary conversion, help property owners defer taxes?
Okay. So 1033 is an IRS code, much like the 1031 code. So 1031 and 1031 exchanges are like for like kind exchanges are specifically specific ways where you can take investment properties and defer the capital gains by replacing it with a like property. Now 1033 is similar, however, it may or may not require like an investment property or so. It could be a like property, like for instance, if it's a residential property that was in a federally declared disaster area, you can take the funds and proceeds in exchange or replace that property within 2 years. Now, that's the big differentiator, because typically speaking, in a 1031 exchange, you have 45 days to identify, and a total of 180 days from the date you closed escrow or you relinquished your property that you're selling to buy another property. In this situation, under the 1033 codes, you have either 2 years for residential properties or 3 years for business or income producing properties from the end of the expiration date of the loss, or end of the year of the loss. So if
Wait,
you
let me
lost,
say that again.
well, what I mean by that, and I know it's a little,
Yeah.
it's let's say the property was lost in May 2025.
Okay.
Okay, so their time frame for the 3 years doesn't start until December 31st.
Okay.
So they'll have the entire 2025, but they'll have 3 years from that. So they'll have additional 3 years to replace a business or investment type property in that situation. So
Okay.
the other difference obviously is because there's no sale of the first property, it's more about income coming in things. You don't really set up an accommodator, intermediary, things like that.
Okay. All right. Can you explain how depreciation recapture works in a property destruction scenario?
Okay. Depreciation recapture is first and foremost, in any scenario, when you're selling a property or anything else, depreciation recapture is probably going to play a little bit of a factor in it, because the main reason people want to invest in real estate, or one of the main reasons I should say, is that you can depreciate that asset and use that to write it off. Now, all it's really doing though is really pushing that along, kind of deferring those taxes on the depreciation, because when you do sell the property, if you sell it for more than the depreciated amount, then you're going to have depreciation recapture. So this is true whether or not you're selling it or if it's from insurance proceeds. So let's say you've depreciated the property and you're just trying to get out of it, and instead of them actually giving you money to replace the property and rebuild it, they're going to say, you know what, we're going to instead, here's the money, we're taking over the property itself. Issue that may come up is that if you've depreciated that property, you have to pay all the depreciation recapture up to that basis point as well, and that's usually taxed at your personal income tax up to a maximum of 25%. So, which is about 5% higher than your federal capital gains tax at 20%.
Okay. Wow.
So,
What if I decide not to rebuild or replace my property? I'm done.
well, if you're done, it's probably going to be treated as income. Now you can deduct. There are still going to be some deductions because you're going to have potentially the asset, or you've lost the actual basis of the land itself. If you're done, you turn over the keys, you give it back to them, whatever else. That could potentially be write off on the basis of what the actual land value is left and remaining.
Okay.
However, all the other proceeds after that are probably going to be taxed as income.
Yeah. Yeah. I can imagine. That's a soft spot right now
Yes.
here in LA. All right. How do tax state laws interact with federal tax treatment in case of destroyed property? Are there major differences to look out for?
Okay. Quick answer: for 80% of the people, no. However, some states do have other laws that may offer more or additional protections or issues that may come up because of that. And what I mean by that is most states try and tie along the same lines as the federal tax laws, the capital gains, things like that, along those lines. Now, there may be some federal, if the state charges capital gains tax, they're going to be applied the same way typically as the federal applies it. The issue that does arise, however, is like, let's say a state of California. In California, you had Prop 13 protection, where the property tax is actually set up based upon what you paid for it at the time of acquisition. It doesn't reset every year like most other states in the United States, where they have a tax assessment department that reassesses every single property every single year. California waits until the sale. So you may have a property that was sold 20 years ago that is only paying property tax for $200,000, but it's worth $2 or $3 million or $4 million, and that's what the property tax should be based upon if they were to sell it today. Well, the issue that arises is if you get property proceeds that are above your basis, insurance proceeds, the state may reassess the property at the new higher property tax rate.
Ooh, could you imagine that one?
It's a big hit for some people.
Yeah, that'd be hard. All right. Are there tax strategies or planning steps that a property owner should take before a disaster strikes to better manage potential tax consequences?
Yes.
What are they?
I knew you'd ask that part. Well, number one is document. This is what some people forget to do because, there are different tax implications based upon whether it's real property, personal property, casualty loss, how it's going about it. So you want to document everything from what your personal properties is at the property itself that may have been lost, as well as what capital expenditures that you've done and how they've been treated, if they've been reported and whatnot. So you want to have that documentation done. And that's not so much before it happens as more of a continuing as you go, a good standard of practice. From there, you want to familiarize yourself with the different laws that may affect you, as well as, meaning in California, we have California Fair Plan for the insurance issues, but we also have other laws that may come in such as Coastal Commission and things like that. So understand how is that process actually going to look, because your cost may be a lot more than what the property value is, and that may be inflated just because of governmental regulations and or hoops that you have to jump through because of the municipality that you're in. So you want to be aware of that and be able to actually document that again and be able to write that stuff off. Now, you also want to be aware of receiving any government assistance, because sometimes government assistance can actually reduce the deductibility of the property that you lost. If you're receiving government assistance, they may actually look at that as either income or offsetting some of the losses that you've already incurred. Government assistance can also be, it can be all kinds. It's not just replacing the property. We're talking about even rent assistance or things like that, or tenant type assistance. Be sure that before you take any kind of government assistance on that property, that it's not going to affect your taxable assets or capital gains issues, or if it is, that make sure it's worthwhile taking it for the taxes that you're going to have to incur.
So there's no free money is what you're talking
No
about.
free money, unfortunately. Not after you turn 18, at least.
Yeah, Mom. All right, last question. Are there any unique tax treatments for properties held in an LLC trust or a real estate investment trust if it's destroyed?
Okay. In that situation, not really, no. Not when it's destroyed. I mean, they're pretty much treated the same. Most of the entities that you talked about, other than like the REIT or so, they're typically pass-through type entities. So like an LLC, it's passed through to an individual or multiple individuals. That's going to affect how their taxes are done. But ultimately, when it comes to the casualty, when it comes to the capital gains and everything else, it's just like you're going to be selling the property. It's just that instead of selling it, you're forced to get proceeds coming in. And that's where the confusion and the issue kind of comes up. It's also why you're given much more time, because if you're in a 1031 exchange, you're planning on selling it, so you have a shortened time frame. But in a casualty situation where there's a fire, earthquake, flood, or some sort of damage that you weren't expecting, they're giving you a lot more time, up to 3 years to actually replace, or 3 years plus the time, the year that you're in, to actually find a replacement property.
It's a lot of great information, George. Thank you for coming on today.
Well, thanks for having me.
And for those of you watching, thank you for taking the time to watch today. I hope this is very helpful. If you have any questions, please don't hesitate to put it in the comments. And if you could, please give us a like. And if you haven't done so, make sure you subscribe.